Good morning. Thank you for joining us today for this virtual event. I'm Eric Kline, a partner at Troutman Pepperlock, and I'm also on the PBCA Board of Directors. I will serve as today's moderator. Before we get started, I would like to thank all of our sponsors, PVA annual sponsors. We would not be here without their generosity and support. Programs like these are only possible because of them. If you are interested in becoming a sponsor, please contact Kelly Shako. We have more exciting events in the works. Moving on to today's event, I'm honored to introduce our panelists, Glen Bressner, co-founder and managing partner at Activate Venture Partners, Evan Cannon, associate at Osage Venture Partners, Martin Fedorko, managing partner with White Rose Ventures, and Anthony Santaro, venture partner at Armory Square Ventures. At this point, let me ask each of you to introduce yourselves and tell us a little bit about your fund before we get to the other questions. Glenn, if you would start.
Thanks, Eric. Good morning, everybody. Activate Ventures, along with its affiliated funds, dates its history back to 1985. In fact, we're celebrating our 40th anniversary this year when my original founding partner and I started with our first fund. We are headquartered in Bethlehem, Pennsylvania, and also have an office in Manhattan. We had our first closing on what would be our seventh fund. So we've been doing this for a long time. Our strategy is to focus on investing on a regional basis in the Mid-Atlantic states, and more narrowly, we have concentrated our investments in Pennsylvania, New Jersey, the metro area of New York. When I say the metro area of New York, I exclude going through the tunnels into Manhattan. We also invest in opportunities outside that region, but on an opportunistic basis. Our strategy is to invest in domain experienced entrepreneurs, first outside institutional financing. We don't mind taking that early stage risk. In fact, the majority of our investments fall into pre-revenue companies. Collectively, we've invested in approximately 150 ventures over our history, had lots of scars on our back by virtue of being around as long as we have. We have a reputation that's easily to be checked out. Thank you.
Thank you. How about you, Evan, if you don't mind?
Yeah, absolutely. Thanks, Eric. I'm Evan. I work for Osage Venture Partners. We are based in Philadelphia. We invest in early stage companies, so seed and Series A, but mostly post revenue, as opposed to what Glenn said about them diving in a bit earlier. It's all been B2B SaaS since we started our first fund back in 2005. We're on our fifth fund now, and today, obviously, there's a bit more of an AI flavor to our investments because that is typically what is happening on us in the software ecosystem today. But overall, we like to partner with entrepreneurs that have some sort of founding experience in the past, or have kind of a unique perspective on the industry that they're targeting with their product, and typically investing in companies that focus on a specific vertical. That could be a department within an enterprise or companies within a specific industry. So yeah, excited to talk more today.
Okay, Martin brings a little different perspective, so let's have you address your background, Martin, and then Anthony can follow.
Yeah, Eric, I appreciate it. And thank you, everyone, for being here. My name is Martin Fedorko. I'm the managing partner of White Rose Ventures. We're today, anyway, South Central Pennsylvania venture firm. If anybody, White Rose is the name for York down here. So we're in York, Pennsylvania. It's about a half an hour south of Harrisburg. Not exactly what people would describe as a venture hotspot, but we have carved out credit niche here in central Pennsylvania through our first fund, which is the White Rose Impact Fund. That was a $12 million fund that we started deploying in late 21. We have 13 investments in it, 10 or so million across those companies. And, just been really humbled to start something like this in an area that, again, is not even, sometimes remotely familiar with venture, but are certainly, looking for companies that grow and scale and see central Pennsylvania as home. We are coming together with 1855 Capital, which is a state college-based firm, and we are co-managing what will be the Keystone Innovation Fund, which is a $30 million fund that will invest all across the state. So I think taking our thesis, which we had, which isn't anything crazy. One, we're industry agnostic. We didn't feel that there was enough of enough concentration in any one industry to really focus on one, but also too, we're really focused broadly at just changing the perception of what we feel is possible, not just in central Pennsylvania, but across Pennsylvania as a whole. Being in central Pennsylvania, we're also close to government. We like to, align with the priorities there as well, but not necessarily, focused on them intently. Again, on the broader scale, just really trying to not just make great investments and make a name for Pennsylvania, but also attract the capital that we know that entrepreneurs here deserve.
Great.
And I can round us out. Hi, everyone. My name is Anthony Santaro. I'm a VP here at Armory Square Ventures. Armory Square, like a lot of the other funds here, is an early stage VC firm, also primarily focusing at the seed and Series A. On occasion, we'll look a little bit earlier at pre-seed opportunities, but across all three, we always look to be post-product and post-revenue. The firm started back in 2014. We're currently investing out of our third fund. Throughout all three funds, it's always been focused on B2B SaaS, B2B marketplace, and as Evan mentioned, more recently, definitely with an AI bent. Geographically, we tend to invest across the Midwest and the Northeast. So we're headquartered technically up here in upstate New York. I'm calling you from Syracuse. We do have an office down in Manhattan, and we have two team members actually based kind of in the Philadelphia region as well. And so we generally lead and co-lead the rounds that we invest in and look to follow on through as the company continues to grow and scale and hit the goals that we kind of outlined at the time of investment.
Okay, great. If you have any questions for our speakers during this event, please use the Zoom Q&A function, and we will do our best to respond during the program. So what we thought we would do first is take a look at the overview of the market here in Pittsburgh. If you can pull that up, Ian. And as you can see, and we'll do this rather quickly, but as you can see from the first slide, we've gotten a significant amount of investment in Pittsburgh over the first 6 months of this year. It actually exceeds, I think, the full year of last year. It has been concentrated in several investments, but as the next slide will show you, you can move on. The deals have been spread across a number of industries, and actually the most deals were in healthcare and life sciences, and that's what I've seen with my clients as well, where we've had a significant number of deals there, followed by AI and machine learning and robotics and autonomy. But these focuses, especially the AI and the robotics, they've actually been quite good for the region, and I'll explain why in one of the subsequent slides. But if you want to go on, we'll look at some of the bigger deals that have been done here. Skilled AI, which raised 500 million. And if you look at the investors in Skilled AI, NVIDIA, Amazon, and Sequoia, one, you're seeing a lot of industry participation, and NVIDIA and Amazon strategics, but also Sequoia, which has been in this market from time to time. And we saw them a lot in the late 90s as well, when we had the big internet boom. So it's a good thing, because if they're here, they may look at some other things in the market. Similarly with a bridge, that was the recent round was led by Andreessen Horowitz. We didn't see them in 1999. I don't know if they were around in 1999, but they are a very big West Coast player. And again, if they're here, they may be willing to look at some other investments. So we're optimistic, and you can see that Gecko Robotics was also a large deal that happened here, and then another life sciences deal that occurred. So with that, the key takeaway is the market continues to be pretty good here. We're seeing some big financings. We're seeing some out-of-town players come in and make some investments here. So that casts more light on this market. So with that, let me turn to the panel itself. And on this first question, I wanted to start with Martin on this one, to provide somewhat of a current state of the markets, because your focus is a little bit outside of either Pittsburgh and Philadelphia itself. And we were wondering what you've seen, and also because some of your money, I guess, is coming from the state of the Commonwealth of Pennsylvania, how do any policies affect your investment, or how does that work?
Great question, and thank you for it. I don't quite have a script, so if I go long, just rein me in here, but a lot to talk on this topic. So one, it's been a pleasure investing in Central Pennsylvania, and also too just starting my career, quite frankly, as a venture investor here. When I started, we all read some of the same folks and same things about higher level trends in venture. And it's always good to keep an eye on that things and what's going on. But what I've probably noticed over 5 or 6 years is Central Pennsylvania, for better or worse, can be a little insulated from some of those macro factors. One of which, obviously are valuations. Valuations, it can be everywhere, especially over the past 5 years with the end of, the ZIRP era and the downturn in, 22. And again, just the general correction on those things. What I will say is, as a positive here, is we never really had to deal with that here in Central Pennsylvania, and that's really just a function of the amount of capital that's coming here. Another way of saying it is valuations continue to be pretty low around here until there is more and more concentration of capital around here as a supply and demand market as well. So I do feel we're very insulated from some of those things, which is great. But from a policy standpoint, I mean, there's the stuff going on in Washington, stuff, state budget here too. Of course, can definitely, I wouldn't say they affect us directly as a venture firm, but via the resources they bring to businesses, whether it's SBA loans or innovation funds that are allocated by the state. Those are major tools for us, especially as venture investors. For example, we work closely with Ben Franklin a lot. I'm sure folks on this call do as well. And it's a fantastic program in the way we look at it. They just de-risk a lot of opportunities that we can come in and have comfort in and make good investments in. So that's the central PA landscape here. What I'll say is in Pittsburgh, while we try to get everywhere possible, the theme everywhere is just lack of capital. No matter if you're in Harrisburg, Pennsylvania, Pittsburgh, Philadelphia, those are again, that is a trend of the current market. Of course, that's something that factors into a lot of things. I will say that again, whether you're in a big city or a little city, everyone's dealing with that. But I'd say that in summary, Central Pennsylvania could be pretty insulated from some of those, whether not that we're immune to AI or things like that, but we usually keep things pretty even keel around here for now.
So I really want to ask Glen this question because Glen has had a ton of experience over a long period of time looking at markets, and wanted your assessment of kind of where we are and where you think we're going in venture.
I'm not sure I have the great answer because it's a changing and has always been a changing and evolving market. But I can cite a few statistics that are very interesting. At least year to date, almost half of the capital that's been invested by the venture community has gone into but 10 companies. Think about that, just 10 companies. And they obviously are in the hot sectors of AI and humanoid robotics. You mentioned skilled AI. I think it was a $500 million round, but I think I had read that it had raised upwards to 800 million recently. And then a good portion of the balance of the capital year to date has gone into what I would call the derivative infrastructure of these industries, data centers, energy sources, in support of trying to make these very big ideas successful. ChatGPT will tell you that over the course of the last 2.5 years, there have been over 30 humanoid robotic companies financed with billions of dollars. So the capital is getting very at least on the high end, concentrated into these big ideas. Hopefully they'll have big outcomes. But what's also interesting is that about half of the venture capital that's been raised year to date by funds has also gone into about 10 funds. And 75% of the capital that the venture capital industry has raised has gone into just about 30 funds. So when you think about the aggregate numbers, these funds have to put that money to work in these kinds of large financings that are where capital is a competitive advantage and competitive weapon, and that the attendant valuations, which Martin talked about, is extraordinarily high. And so the outcomes have to be extraordinarily high. I don't know whether all 30 of these humanoid robotic companies are going to succeed. I hope they do, but past this prologue, there will be a few successes and there will be some disasters. Another important data point is that year to date, more liquidity has been generated through what are called secondary financings, taking out the primary financing interest at substantial discounts to what the valuations were, providing liquidity for both the funds, the limited partners, as well as the individual entrepreneurs. And that is actually larger than the amount of capital that has been raised through IPOs year to date. Now, IPOs may not be liquidity events, but they're measured as being successful, exits. Just yesterday, a company called Kline went public, which is actually headquartered in Sweden. And it was celebrated having achieved a $15 billion valuation, having raised $1.4 billion in the public market. Well, interestingly, just 3 years ago, it had raised its last round of private financing at a $45 billion valuation. 3 times what it was valued in the public markets. A lot of these secondary financings are at discounts even less than that, or more than that, excuse me. So I think that is one extreme of the market. But similar to Martin, I think that the traditional, what I call traditional venture capital industry is timeless, it's evergreen, focusing on domain experienced entrepreneurs who are trying to build miracles out of ideas or their dreams. They've got experience in the marketplaces in which they're trying to build these businesses and are applying relevant technology to solve important business problems and are doing it within the constraints of the traditional exit opportunities that the venture capital market generates any given year. It looks like a pyramid. At the very top of the pyramid are these ones that everybody's talking about, everybody sees. But when you go down the base of the pyramid, the vast majority of successful exits are still under $100 million. And I think that opportunity is still very real and very opportunistic for regionally focused funds like ourselves. In terms of the climate, and I'll try to be brief on this, but this morning I was listening to the vice chairman of Sandler O'Neill on CNBC, and he says, with the new administration, for all the frustrations that a lot of people have, it's really the sun's coming out. Regulatory restrictions are getting reduced. There had been not really any substantial M&A activity in the financial services industry for the last 5 years. That's thawing. There is a new, or with a big, beautiful bill, an expansion of what's called the QSBS 1202 exemption for federal gains, capital gains taxes for federal purposes. That opens up, along with the opportunity for other kinds of investment vehicles to invest in alternative assets. So I think the flow of capital is going to continue, if not exceed. And there will be a lot of interest in being opportunistic in what we do, which is the antithesis of these, unicorn chasing strategies that a lot of we all read about it is having. I think we're overwhelmed with the amount of opportunities to look at the moment. So I think that the entrepreneurial mindset, the ethic, the drive is alive and well.
Great. To expand on one thing that Glenn said, so most people are familiar with the QSBS. It stands for Qualified Small Business Stock. And what it is it's essentially an elimination of the capital gains treatment if you invest in a startup that's less than 50 million in assets. It has to be a C corporation, and you hold that asset. Previously, you had to hold it for 5 years to get the exemption. Now you can get part of the exemption after 3 years and the full exemption after 5 years. So it's a big selling point for many investors to come into companies like this, including maybe some of the people in the audience, because nothing's better than having a huge gain and not paying taxes on it. Well, you would still pay, I think, state taxes, but you don't pay federal taxes on it. So with that, let me move on to another question, and I want to start with Anthony on this question about areas of interest, because I know that, again, you guys take a slightly different attack on the type of companies you invest in. I'm sure they all have an AI bent in some regard or not or another, but but it's really a different approach to that kind of investing. So you could tell the audience a little bit about what you guys go after, what you think is very hot at the moment, and maybe how companies can position themselves a little bit better to be in those kind of spaces.
For sure. Thank you. Happy to expand on kind of the areas that we invest in. So, as I mentioned earlier, broadly, it's going to be exclusively in B2B, business to business businesses or startups, and it's always software exclusive. So, we don't typically invest if there's a hardware component, even if it's kind of not proprietary to the business and can be off the shelf. It's just not an area that we've spent a lot of time in historically. And we're generalists kind of broadly within the business models of B2B SaaS, B2B marketplace, and again, vertical AI. I would say, Eric, to kind of expand on your point, that we do tend to spend a lot of time in what we would call like old line, more legacy industries. So this could be transportation, supply chain, manufacturing software. And so anything that we feel these industries are still kind of going through digitization. And I think that that's only been more so the case since AI. And so more recently, when we've been looking at some vertical AI companies, as far as like positioning yourself, some of the points that we've been looking for would be really the domain experience of the founder. So when they're building these vertical solutions, whether it's in legal or some of the other industries, automotive, that I mentioned, I think when having gone through the pain point of the customer experience yourself, maybe you were a practitioner, maybe you were at a different company that previously sold into the space, and you have a really good read on the industry sector, is something that we put a huge premium on, from an investing point of view, and being able to kind of recruit a team around you that's, mission aligned to those areas. And so that's something that's really important for us. And then more specifically with vertical AI, we looked for it as well with B2B SaaS. But Glenn, I think you had mentioned that, for example, like humanoid robots, there's like 30 or so maybe well-funded competitors, and there's obviously a plethora of competition within each kind of like AI pain point. So any way that you can kind of show differentiation, so whether that's through the founding experience or being able to stand up proprietary distribution channels, would be something that we really look highly upon from an investment perspective.
So since you look at some of those legacy type companies, is there a bleed over with private equity in some of that? Or will there be deals that you might ultimately do with private equity firms where, because these are established companies, or maybe they're just attacking more established niches?
Yeah, no, I think that's a great question. And so we haven't, for example, partnered with, a sponsor on kind of co-investing or anything along those lines. But to your point, Eric, for example, like we're looking at a deal now that's in the home services space. It's, pure B2B software with an AI component. So it's very much a venture kind of startup mentality. But that being said, there could be a really interesting channel partnership with different private equity firms that tend to be doing these home services roll-ups of the actual like kind of more old line businesses themselves. So these could be painters, HVAC, plumbing, electrical, things along those lines. And so I think there's a way to partner in the sense of setting up distribution and maybe selling to a captive audience of their portfolio companies, especially because they could have a portfolio of numerous different companies within the space, and doubly so if they're pursuing a roll-up strategy. But that would be kind of not from an investing point of view. Maybe, some individual partners might express interest in investing from an angel perspective, but not, a sponsor kind of joining us as a co-lead or anything along those lines, at least not yet.
Okay. Evan, could you maybe address this question as well, which is, the areas of interest and the
Yeah,
hot areas in particular, and how companies maybe can position themselves a little bit better?
yeah, for sure. I think that for us, the biggest challenge over the past, I don't know, 2 years, I guess you could call it now, with the advent of AI is trying to determine like defensibility. So like how a company actually continues to have a product that is better than everyone else's product. The barriers to entry for building software have declined significantly in the past 18 months, particularly with Cursor and other tools like that that allow non-engineers like myself to build things quite easily. So for us, it's been more about assessing whether the founders have unique access to certain networks, and particularly how they distribute their products and how they go to market. I think we've always been interested in companies that sell to SMBs, and that has been an area that I guess most people when they talk about B2B SaaS, they say enterprise SaaS. We don't necessarily not invest in enterprise SaaS, but we definitely focus more on companies that have a bit of a faster go-to-market motion, And I think that is a bigger problem to solve now than technology. Obviously, having a good technology and a good product is important. But the thing we really focus on now, even at a very early stage, is how you get that product into people's hands, and how you can create a really good ROI case to convince people that it makes sense to buy the product. So really diving into early go-to-market metrics. Hopefully they have some sort of inbound lead generation engine running, and have a way to go from a small amount of revenue to a large amount of revenue on a small amount of capital. That's kind of what we're interested in and looking at the moment.
So just to follow up on that, when you look at this going from scaling from a smaller company, bigger company, do you help with the management team? What happens? Because often the entrepreneur who starts things is, it's not the one that can necessarily scale it, but they might be involved with the company, just not as the CEO, let's say.
Yeah. I mean, for us, it's one of our main kind of theses. When we invest in a company, we expect the founder or the CEO we invest in to remain with the company for the entire life cycle. Sometimes that doesn't work out, of course. Things don't go well a lot. So sometimes we have to make changes, but for us, that's our initial thesis. But yeah, when we come in, for us, a lot of the scaling today has been helping our founders to assess and choose the right technology to enable them to scale more efficiently. There is tons of stuff out there. I think that is also a problem. There's an awful lot of noise out there about what is actually valuable to help build your business, whether that be in engineering or product, as I mentioned earlier, or in sales, in marketing, etc. But for us, it's helping founders find the right people. So whether that be a person to lead the technology organization, sales, whatever it could be. But then also helping them. We have a big portfolio of active companies, and we like to try and spread the wealth of knowledge across those companies. So we recently had one of our portfolio companies who have kind of revolutionized their outbound lead generation engine, present to the rest of our portfolio to show like these are the things we did, because we don't invest in competitors. So we never invest in a company that's competitive to one of our portfolio companies. So getting that kind of information across our portfolio is extremely valuable. And we always hope that they listen, but we can't tell them exactly what to do, but we hope that they implement some of those learnings across the portfolio as well.
Which is another kind of key takeaway, which is good venture capitalists can actually help you with your business. It's not just the money. It's the network of even helping them with the technologies that they may want to deploy, which they may be familiar with some and maybe not all those technologies, and plus the experiences that you've had across your network. I was going to ask Martin kind of the same question, just because I grew up in central Pennsylvania, so I know there's a lot of old line industries there. How are you seeing these particular areas that are hot and not hot, and how does this play into your overall investment scheme?
No, I appreciate it again. So I think I'll start from this angle. So we obviously try, just like everybody else, to make sure we're as open or an open door as possible to all entrepreneurs to be able to, share their business, what they're working on, what they're raising, things like that. On our website, we have a place where you can fill out a type form that gets into our system and things like that. One of the things when we started this in 2020, 2021, that I didn't quite realize would end up being the case is, of course, we have, by virtue of being one of the few, if only, capital sources for this asset class here in central Pennsylvania, of course, we're going to get a lot of deal flow from venture companies, but also too, what I didn't quite realize is just by being a capital source, we actually get all kinds of opportunities, or people report all kinds of opportunities. So it's not just hey, we're raising $1 million round at this valuation and we're going to do X, Y, Z. Sometimes it's someone who just wants to sell their business. They're like 40-year-old family-owned business. Sometimes it's people that want to sell a minority stake in their business. Point being is I feel like we've become not just like a venture hub necessarily in central Pennsylvania, but we've really ended up getting quite a deal flow that spans venture and private equity, and that middle ground, where people don't quite know if it's venture or private equity. Regardless, here in central Pennsylvania, and I think to an extent across the state, outside of some of those examples that we just talked about, it's never really been about hype cycles. really at all. It's really just, I hate to sound boring here, but it's just like, business fundamentals and just, getting good businesses to exit for good multiples and what exactly are those metrics for each company based on the industry and, just who they're trying to sell to that you really need to attack to make sure that you can maximize, exit value out of there. So at the end of the day, I said that all like everybody knows what I just said. It really is more just like basic fundamentals around here, and we just not playing the same game as investing in billion-dollar plus valuations, and to Glenn's point about like 30 companies and things like that. That gives me anxiety just hearing that as an investor. Meaning just all the capital that's gone there, and we'll see what comes out in the wash, I guess. But here we're kind of focused mainly on those businesses. And just lastly, just like the central Pennsylvania tilt, this won't be an AI hub here in central Pennsylvania, but what they do really well here in central PA is manufacturing and now advanced manufacturing. And at some point, AI is advancing, faster than we can keep track of, but the hardware application of that, will temper it a bit. And that's where I think too that, or temper, the usability, of those technologies and the hardware that, whatever they're trying to build here. That's something we uniquely do well here in central Pennsylvania, of course, in other areas of the state, but that's where I think too that we could tie in well with the ambitions, broadly speaking, of the state.
So I'd like Glenn to also address this question, but also kind of a follow-up, which is, how, not maybe, how often do you get into this market, and how would people access you? Which I'm going to ask everyone that, but first I'd like to find out what you think about this question, Glenn, since you've worked with a lot of companies over a long period of time.
I think there were a couple of questions. One is, feel free to give me a call. I think that's the easiest way still to engage. Try to be as responsive as possible. Part of our task is to be accessible. And ultimately, our reputation is really important to us, and we want people to feel like that's who are trying to raise capital. We understand the challenges associated with that, that we want to make sure that we're as responsive as possible. We've probably still are the most active historically active investor in Pennsylvania. That includes central Pennsylvania. And, we've invested in almost 10 ventures in the greater Pittsburgh area. We look for a certain set of characteristics about the founding entrepreneur, and it's their experience in the markets in which they're trying to build their businesses. And especially if they come from a sales background, we think that we look in the rearview mirror, that's the most critical skill set in terms of being able to successfully develop technologies, is to be able to have relationships with your intended marketplace, customers that will be early adopters. Developing new solutions is really an iterative process, and being able to gain feedback from trusted sources in the marketplace to get the product market fit perfected, get the benefits set, what they need done, is really an important thing, especially in today's environment. I think Evan alluded a little bit to this, is development time cycles have really been truncated. When I first started 40 years ago, the use of proceeds in our financings would at least half go into actually the development process, which could take a year or longer. And then the balance would be into getting the early commercialization activity started. When you fast forward into around the 2000 timeframe with some of the software advances using development tools like Python and other kinds of things, that was reduced from a time standpoint. So the majority of the capital all of a sudden would be directed to the commercialization activities. Think about it today. I mean, you don't even need developers in some cases. You can get software developed that allows you to get into the market in literally a few months. And so the ability to engage with your marketplace really early is really important. And having that domain expertise becomes even more critical, so you can adjust, you can refine your product market fit. And I think that that's critical no matter where you're investing and what types of industries. And there's so much industrial history in the market we're focusing on in key sectors that we just continue to do what we're doing, finding people who have scar tissue in their markets, that have the tremendous ambition that they want to create a miracle out of their dreams, and it's timeless. So we continue to feel like We're in a very good spot. And the supply and demand equation continues to be, for capital that the type of capital we manage continues to be a problem. There's an undersupply of what we do in our marketplace.
So maybe Anthony, and again, I want everyone to address this because I think it's a key question for for this audience, which is, are you how often are you in this market, and how do people get a hold of you? And maybe what makes a proposal stand out?
Yeah, for sure. So as far to answer the first part of the question of how often am I physically in the market, I probably make it to Pittsburgh 2 to 4 times a year. And so typically around like Three Rivers Venture Fair and some of the other events. So if there's like an event in town, then I'll try to build some other meetings around it, meet with the Innovation Works team and just some of the other local players in the space. And so we firmly believe, whether it's Pittsburgh or some of the other cities, that we spend time in and want to make investments in. It's really important to spend time locally on the ground, meeting with people face to face, and really building that relationship over a longer period of time. So, that's something, and it's not just myself, it'll be other of our partners as well that will be making the trip down to Pittsburgh. And so, we try not to just come in and out once a year or only be known from Zoom screens, but to, again, really build relationships up with people. As far as like best ways to get a hold of me, always happy, email, LinkedIn, other messaging. I think obviously my LinkedIn's public and I think our emails are on the website, but it's just anthony@armorysv.com. And, always read all emails that I get, whether it's an investment proposal now or just asking to connect, or, maybe next time in town we can grab a coffee or something together. So always open to building a relationship over the longer term period of time.
So when you meet with Innovation Works, do you go through the portfolio companies with them and say, what are you seeing that looks good or that we might be interested in? How does that relationship work?
Yeah, so it could be something along those lines. It could be, I think they do newsletters, so kind of seeing what have been their most recent investments, or maybe, because I'm going down a couple times a year, oh, these 2 or 3 companies were a little bit early for us from an investment standpoint. Now, 6, 12 months plus later, how have they grown? What have you been experiencing? Does it make sense to me to reconnect? And so just kind of being, whether it's Innovation Works or other investors or service providers that are just locally in the ground, they're just going to be a lot closer, in hearing, up-to-date information and, who might be raising and who just made a key hire and whatever it may be. So it's really kind of coming in from out of town, but still making an effort to show up and be there in person as well, to meet with the folks that are kind of more in the flow, just by virtue of them being based there 24/7. And so that could definitely be how the relationships develop for sure, Eric.
Okay. Well, Evan and Martin, if you could both address that, the question as well about meeting you and, again, meeting you and how often you're in the market.
Yeah. I'm pretty similar to Anthony. Our email is on my email is on our website. You can reach out over LinkedIn. We'll take a look at anything. We don't do much. We're not restricted by location on where we invest either, so we're open to pretty much anything. How often we're in the market? We've invested in 2 or 3 Pittsburgh companies in our lifetime. We lost on a Pittsburgh company about 18 months ago. I remember that one. That stung pretty hard, but they're doing well, which is good to see. And to be honest, like, it's pretty similar to Philadelphia in the sense that it has great educational institutions that just drive a ton of great research and allow for really smart people to come to the city. And whenever really smart people are in a certain place, then you get great businesses that come out of that. So for us, it's important to take advantage of that whenever we can. So try and get there at least once a year. It's not very far away from us, so that's where we usually go to different cities across the kind of eastern half of the US, and try to meet with the kind of Innovation Works is a great example of just local investors who really have their feet on the ground and know the companies to speak to. So anytime we go to a new city or a city that we've been to before, it's about meeting those types of people that can really connect you to everyone there. So I would assume if you're involved with Innovation Works, that's a great way to get to us. But realistically, I think most VCs are more open to just straight up cold emails than you realize. And like Anthony said, I'll read anything. So that's probably the easiest way to get in touch.
Yeah, I would also mention, just before you start, that LifeX also assumed kind of the mantle from the life sciences greenhouse. So I don't think most of the investors here are life science investors, but that's another place where, you know, entrepreneurs may want to get a little early vetting through LifeX, because it might be on the radar of some of the life science investors. Yeah, I'm sorry, Martin. Good.
Oh no, I was just gonna wait. So no, as far as getting to Pittsburgh, so one, I'm born and raised in Pittsburgh. I'm a Pitt graduate. I love the fact that my job now takes me back there as much as I can. So between fundraising and sourcing opportunities, and just in general building more partnerships around what we're up to, I would say I try to get there once a month. It's probably, you know, twice every 3 months or something like that. But between me and Dustin, on our team, we probably get there once a month. Oh, you know, as far as the dynamics that are concerned, yeah, of course, Glenn, you know, said too. It's to me, it's interesting. You know, coming from Central Pennsylvania and going to Pittsburgh, you have just so many more resources than Central Pennsylvania does around the advancement of innovation and technologies and research, whether it's the universities, whether it's the corporate presence there, or just the general, you know, zeitgeist that's in Pittsburgh today. And it just, but you have that on one end. On another end, you hear anecdotally just, you know, early stage is just not being addressed there. And I know we all probably have perspectives on that a ton, but you know, for me personally, I can't think of you know, a ton of better places right now that I think is um, ripe for early stage venture. Especially, we talked about all the money that's been invested in venture. Of course, that's mostly later stage or bigger rounds, but you're also getting more and more investors that are just becoming comfortable with Pittsburgh, getting to know Pittsburgh. And I don't know, I feel like that money will trickle down to earlier stages at some point and be able and support what we all hope to do is just continue to build that pipeline so that, you know, that 1.3 million, or I think I always heard like 3 million or 3 billion, I'm sorry, in venture was in Pittsburgh in 23. You know, that could be way more as well. So extremely excited about doing it. And yeah, between fundraising and sourcing opportunities are probably there once a month.
So we had a couple questions from the audience. Let me ask you about them. One is, the first question I think is, if you lead rounds, or it says or follow on, but that just may mean or just are part of the syndicate in rounds. If you guys would address that in any uncertain order, maybe start with Glenn.
Sure. We prefer to be the lead, the first institutional lead investor in an entrepreneur's financing. Part of our strategy is to, at the time we make our initial investment, is to organize a like-minded group of investors should we determine we're not able to complete the journey ourselves and need partners to do that, to bring those in at the same time, so that collectively we have the capacity to complete the journey without being dependent upon somebody else. That doesn't mean you don't take advantage of that, but the worst thing to do is to occur is to put yourself in a position where your back is against the wall, you're out of resources, you're making good progress, and some of the more opportunistic investors decide that they can take advantage of that. So that's really important for us. So we not only are comfortable being the lead investor, for every dollar that we put in the very initial financing, we typically reserve twice as much for supplementing the initial investment. The amazing thing about this is no matter how good things go or how bad things go, it always translates into a need for additional capital. And so by experience, we've learned that lesson. And so we want to make sure that we're there. Sometimes the best outcomes for us, and I still think is very much part of our strategy, is where you don't ever have a secondary or another financing. It gets dilutive. The motivations from the new investors may perhaps, and the timelines might be different. So we like to all be in the same boat with an alignment around the objectives and goals. So I think that's an important feature to our strategy.
Yeah. Anthony, and then if the rest of you would also address that, because I think that's a pretty important question to everyone, whether you're a lead or whether you're really more in the syndicate.
Sure. No, similar answer. So I would say probably 90-ish% of the time we're leading or co-leading the rounds that we invest in. On occasion, if it's an entrepreneur that we're familiar with, so for example, a founder that we had previously backed, or are familiar with whoever the lead is, we may follow in the round. But the vast majority of the time, we're leading or co-leading, putting together the terms. And to Glenn's point around syndicate, we think that's also really important as well. And so having a strong syndicate at the time of investment, we think benefits all parties.
Yeah,
Yeah,
we're
Mark.
flexible. We will lead, co-lead, follow on. If we like an opportunity, we'll figure out a way to get involved.
Yeah, I would say too on our end, we probably lead more often than not, just because, in our area, there's someone, we're really the only institutional investor, or probably the closest one to the company. So we usually need to raise the hands and bring, other folks in and bring the comfort there. So, and even too now, Glenn said, we prefer to be, I'd say we prefer to be as well. I think, too, you want to be able to get companies off on the right foot with, I don't want to just say standard terms, but terms that will carry through and serve them well. We've all experienced companies that have had kind of sideways terms as they've come to you, and I like the idea of us being able to get them off on the right foot.
We also had a question. Will the speakers be at the AI Robotics Venture Day, which is later in September? And I guess if you're not going to that, what are the things that you attend here, the Venture Fair, et cetera? Maybe we'll start with Evan on that and see what about that.
I will not be at that specific event. Yeah, I'll be at the Venture Fair, obviously. Other than that, just to be honest, we try and just plan trips to cities and see what's on when we go there. So there isn't anything else specific that we go to, but we usually try and find things that make sense when our schedule lines up.
Okay.
I can go next. Just following Evan. As of right now, I'm not going to that summit, but I'd say in general, when I think about our travels, we like to get to some of the conferences, the Three Rivers Conference, the Penn State Conference, especially ones where we can truly interact with investors and entrepreneurs. I think, this AI summit and some of the stuff that Pittsburgh and then in Philadelphia is doing in the life sciences is incredible to raising the perception of what is possible around there. I would just say in general, I'd like to, when we're traveling, just, the conferences are usually really helpful for us. The summits can be whirlwinds a little bit, and but regardless, they're just great for what we're all trying to build here across Pennsylvania.
And that sort of to your point, the AI Summit, which I think was largely organized by Dave McCormick, who is now senator. So Dave has a long history in Pittsburgh. He was actually the CEO, not the first CEO, but a CEO of Free Markets, which was a company we represented in the late 90s. So having that kind of business background, I think, among other things, makes him a person who is well able to advocate for industries, and those are the industries that we think we'll see in the future. If Anthony, could you address the issue as well? And
Yeah, happy. So it is on my calendar. So as of right now, barring any last minute changes, I'm planning on being down there and looking forward to it. Like I mentioned earlier, coming in town for conferences such as these and really having a pre-built schedule and then being able to selectively add meetings around that really helps, justify the time that it takes to kind of travel there. So excited for it.
Glenn?
Between or among my colleagues, we're out in Pittsburgh at least 6 times a year. We up until about a couple of years ago had actively been out there on a monthly basis with a portfolio company. I am going to be out of the country towards the end of the month on vacation, and however, one of our associates is expecting to show up for the robotics conference. So we try our best. It turns out that the drive, there used to be a direct flight from the Lehigh Valley to Pittsburgh. It doesn't exist anymore. So either we have to get to Philadelphia or decide to drive. And it's longer to drive to Pittsburgh than it is almost anywhere in the mid-Atlantic states, but it's certainly a part of our ongoing effort. There's a lot of beautiful farmland between the two locations. So,
Glenn, I wanted to ask you one other question before we stop, and the others can comment on it as well. But that is, what sort of breaks the log jam that allows you to start seeing exits, in your experience? In my experience, it's that oddly enough, you start seeing a lot of IPOs of leading companies, and that in a way then you start to see the exits among the companies that are below that level. But I'm wondering what you've seen and what you think we will see.
Yeah, we've enjoyed a dozen IPOs over our history. And that has been a trigger event. Obviously, there's going to be some valuation inflation that comes along, and public companies then all of a sudden become more aggressive in terms of their need or desire to be active in M&A activity. I think we're on hopefully a trend of that materializing. It's been a while for that. That's more, you can't time that. I mean, those are externally driven events more than what we do or are able to control. More recently, however, and it's interesting how much money has flowed into the private equity industry. And I think there is a increasing effort on the part of private equity funds to reach down into the venture community's portfolio companies to find out whether there are opportunistic acquisitions and where they can apply their quote unquote value add, and which includes doing consolidation strategies, which is very interesting in terms of what that signals. As I mentioned earlier, the secondary market's been quite active, and it probably is going to need to be still very active for some time to take out some of the excesses in the valuations that have occurred and the lack of liquidity at the same time that is experienced before things get down. However, all that said, I think the most important thing that we've learned over many cycles is you build great, enduring companies that are focused on servicing customers, continue to be focused on being capital efficient, not thinking that raising capital in itself is a success milestone, but is a means to an end. If you create fundamental value and you really build something that's differentiating the market, you will always have choices. Notwithstanding the exits we've enjoyed over a long period of time, the most significant ones still remain the strategic acquisitions. And if you do focus on creating real value, servicing your customers, there will be times when you can control the exit, whether it's in a hot market or not. And, we're not in a rush. We celebrate when it's the right time with our founders. It's more important to them than it is to us. But I think we're in a marketplace that it's the have and have nots. I think when everybody thinks about these crazy unicorn valuations and what all that means, there's a whole layer underneath all that still is vibrant. I actually was a partner in a manufacturing company with my brothers. We had a very, very happy outcome last year. We sold to the largest publicly held company in Sweden. And we were able to achieve what our father had originally envisioned for what he wanted, based upon just sticking to the right principles of building value, focusing on your customers, and being very efficient in how you deploy capital. And I think that's a timeless strategy, no matter what the climate is.
Yep. Well, thank you all very much. I think you've really given a great presentation for everybody in the audience to really, understand where the current trends are and things that they can do to help themselves improve their ability to get funded, maybe as investors to learn a little bit about some of the areas, not just in the hottest areas where people are making investments and so on. So I also want to thank the audience for attending today and hope that you got a lot out of it. There are many exciting events coming up for the PVCA, but we would like to remind you about a few in particular. There's a life science evening program will be held on October 9th at the Left Field meeting space. Additionally, the next Three Rivers Venture Fair, which you can hear that I think every person on the panel is will be attending, or someone from their organization will be attending. So it's a great place to go if you want to meet investors. Will be held on February 4th and 5th at the Rivers Casino. And we hope that everyone will consider joining us. Again, thank you again for joining today, and enjoy the rest of your day. And again, thank you to the panel for really great discussion. Really appreciate it.
Thank you.
Thank you.